Hello everyone and welcome. My name is Dan Sampaio and I'm delighted to open today's Mondac webinar in association with Ropes & Gray, discussing recent, pending and proposed developments in ESG and CSR legislation for US-based companies. We're joined by a wonderful panel to take us through today's discussion. Michael Littenberg advises a significant number of leading companies, managers and asset owners on ESG, CSR, business and human rights and supply chain compliance matters. Michael has advised on these matters for more than 30 years and is widely viewed as one of the leading practitioners globally in this rapidly evolving area. Mark Rotter joined the Capital Markets Group of Ropes & Gray in 2021. Prior to joining the firm, Mark practiced in the New York and London offices of another prominent global law firm. Mark concentrates his practice on advising buy-side investors, issuers, selling shareholders, underwriters, and other market participants on securities law matters and capital market transactions, including public offerings and private placements, beneficial ownership reporting, Section 16, resales of restricted securities, insider trading, and other regulatory issues. And completing today's panel is Sam Elliott. Sam is an associate in Ropes & Gray's ESG, CSR and business and human rights compliance practice. Sam began her legal career as a corporate associate, specializing in mergers and acquisitions. Having focused on corporate responsibility and sustainability for the past few years, Sam now uses her corporate foundation to advise clients on ESG matters. Now, before I hand over to the panel, a housekeeping item. You are able to submit questions to today's panel by typing them into the control panel on the right-hand side of your screen. You're able to submit questions at any time, and we will endeavour to answer as many as possible during our Q&A at the end of today's presentations. Any questions that aren't answered will be forwarded onto the panel, who will be in touch. It's now my pleasure to hand you over to Michael, Mark, and Sam to begin. Thank you.
Thanks a lot, Dan, and welcome everybody. I think we have a global audience today, so good morning, good afternoon, or good evening, depending upon where you're calling in from today. But it's a pleasure to be here with all of you, and thank you to Mondac for giving us this opportunity today. Let's go to our next slide, please. So I think Dan did a great job going through our bios, so we're not going to cover this information, but I thought it maybe makes sense just to, as context, give people a little bit of information about our practice. And we're not going to make this into a Ropes & Gray infomercial, we promise, but just a little bit of high-level detail on the practice. I think we're one of the earliest entrants into the area of ESG, CSR, and business and human rights. We've been at this a long time, both informally and then also as a formal practice group. Our roots in this area go back decades. We have a whole team of us here that do this work, not only here in the US, and the three of us are all New York based, but we have other team members in our offices throughout the US, but also in Europe and Asia as well. And we're advising more than 300 clients globally on one aspect or another of their ESG, CSR, and business and human rights program. That includes not only leading corporates, but also asset managers, asset owners, and trade associations as well. So let's go to our next slide, please. And I think it's probably as evident to everybody from not only the title of the program, but just your market knowledge in this area generally, is ESG and CSR regulation is increasing. We've seen a lot of regulation that's not only been adopted over the last couple of years, but a lot of legislation that's in the pending stage or earlier in the proposal stage. And we're seeing really the velocity of development in this area increasing exponentially. I think hardly a week goes by that we don't see some piece of legislation either proposed or that's moving forward. I think before we get into some of the specific instruments that we want to talk about today, I always find, for me, it's kind of helpful to be able to bracket how I think about topics or put things in buckets. And I think ESG and CSR legislation lends itself to that. So if you're trying to kind of bucket different pieces of legislation here, I think broadly speaking, most of it fits into 4 buckets. So disclosure only legislation. So basically legislation that doesn't require you to take specific action beyond talking about what it is that you're doing. And of course, the intent of that sort of legislation is to create a race to the top through transparency. Second, kind of expanding on that legislation that requires disclosure, but also requires risk assessments, but doesn't necessarily require otherwise changes in substantive behavior. So things like the U.S. conflict minerals rule, for example, which we're not going to talk about today, fall into that bucket. Then kind of expanding on that legislation that requires not only disclosure, but also requires risk assessments and then requires remediation of those risks. And we will talk about that type of legislation today. And I think a really good example of that is mandatory human rights due diligence legislation. And then finally, trade-based legislation, so regulation that tries to deal with corporate social responsibility issues through a trade-based approach. And we'll talk about some of that legislation today as well. And so today we are going to focus on recent developments. We're not going to talk about everything that's going on in this space. We're tracking internally now more than 75 different legislative instruments, not only adopted, but at varying stages. So we're really just going to kind of scratch the surface here today. But really what we're going to do is we're going to focus on pieces of legislation that are relevant to US-based businesses, and relevant to US-based businesses either because they're multinationals and they're subject to these requirements abroad, or maybe they're subject to them because they're in the US, or they're subject to them because they're likely to be in the value chain of somebody else who's subject to these regulations. And these are the ones that we're going to talk about today that keep coming up over and over in our conversations with US companies. But of course, there's many others as well. You'll see as we go through the materials, there is going to be some extra detail on the slides. We're not going to cover all of it today, but we wanted to make sure that we give people, kind of enough leave behind detail, to help them kind of on their own kind of think about these pieces of legislation and understand them. And then also we'll leave a little bit of time at the end for some questions. So as Dan mentioned, certainly put your questions in the chat room. We've already gotten a lot of really good questions ahead of time from the audience, but we want to make sure we're able to address your questions today if possible. So we bucketed the legislation we're going to talk about today into kind of two groups, kind of 4 to manage, so ones that have already been adopted, and then 4 to watch, so ones that are kind of coming down the pike. We're going to change the order up a little because we want to talk about these thematically. But a couple of just kind of high level, kind of things to kind of be aware of that cut across everything we're going to talk about today. Almost all of these pieces of legislation are going to require enhancements to your internal processes and procedures. Most of them are going to require disclosure beyond what you're already putting out. And then also, in a big departure from, what we've historically seen around a lot of ESG and CSR related legislation, there's penalties or other consequences for non-compliance, and in some cases pretty significant. So as we go through the different pieces of legislation today, I think there's kind of 3 things you want to be asking yourself or thinking about as we go through these. One, are you subject to the particular piece of legislation? So is there jurisdictional nexus that kind of picks you up in it? But even if you're not directly picked up, or you indirectly picked up because you're in somebody else's value chain who is going to have expectations for you. So you may not have to comply with everything in the legislation, but you'll probably have to then address pieces of it to satisfy commercial considerations. And then finally, as we go through some of the different compliance items, are your compliance procedures sufficient, or are there things that you're going to need to bulk up internally within your own company? Let's go to our next slide, please. So I think it's important to keep in mind, we're going to talk about regulation today, but regulation is really just one piece of the puzzle. For many leading companies, including many of you who are on the phone today, regulation is, it sets a floor, not a ceiling. So many of you in your practices go beyond what's regulatorily required, and there's a lot of different reasons as businesses that many of you do that. Some of those reasons are highlighted on this slide today, which we won't go through those, but this is just, I think, one of those good leave behind slides to kind of help frame, kind of regulation in this area in the broader context. Next slide, please. And so for our first piece of this, I'm going to turn it over to Mark. Mark is going to talk about climate disclosure regulations. And this is an area that to date has been largely voluntary, but is quickly moving toward mandatory, as Mark is going to talk about. And this is a big area of focus for U.S. public companies in particular, but it'll also, create compliance expectations and requirements, for companies who are in the value chain of U.S. public companies. So it's going to have a much broader impact than just the public company population. And so let me turn it over to Mark, who's going to walk us through some of the regulatory proposals in this area.
Great, thank you, Michael. So we'll primarily focus on the SEC's proposed rules today, and touch on some of the other initiatives that are going on within the states and globally that could affect U.S. companies. So as I'm sure most of you know, on March 21, 2022, the SEC proposed rules that would create a new disclosure regime for climate-related risks. Comment period on those rules ended on June 17. That proposal followed a public consultation requesting input on climate disclosure, launched by then acting SEC Chair Lee in March 2021, a sample comment letter related to climate change disclosures issued by the Division of Corporation Finance in September 2021, and an increased and ongoing focus on climate-related issues by the SEC staff when reviewing disclosure. So the sample comment letter largely followed the views expressed by the SEC in 2010 when it issued an interpretive release on disclosure related to climate change. That 2010 interpretive release took a principles-based approach to climate disclosure, focusing on areas where the SEC's existing rules called for disclosure about climate-related issues. That continues to be the guidance that's in effect today. The rules recently proposed by the SEC would take a very different tack. They would create an extensive and prescriptive new regime for climate-related disclosures. Can we go to the next slide? So if adopted, the SEC's proposal would represent some of the most significant changes to the SEC's disclosure rules for public companies in a generation. It would substantially change the information SEC registrants are required to disclose regarding climate-related risks, requiring the development of new controls, procedures, and data collection practices. As Michael was saying, that will also have a knock-on effect on companies that are not registered with the SEC, private companies that do business with SEC-registered companies. Not surprisingly, the proposal has been extremely controversial. The SEC's received about 14,000 total comment letters. Of those, about 4,000 are unique letters, with the remaining 10,000 being form letters sent by multiple persons. Even excluding those 10,000 form letters, the 4,000 unique letters sent on the climate proposal is orders of magnitude greater than what one typically sees for SEC rulemakings, including in other recent high-profile proposals. Now, for example, the SEC received less than 200 comment letters on its recent proposal to amend 10b5-1 plans, and less than 100 comment letters on its recent proposal to reform rules governing SPACs. So this is very much an area of a heightened interest among both the public and people that think hard about SEC rules and regulations. It's not clear when the SEC will move forward with adopting its proposal. While it does seem to be a priority for the Commission, the scope and breadth of comments received, together with the high likelihood that any final rules may be challenged in court, may have an impact on how quickly the SEC can move forward with it. The proposal has 6 main elements. A new note with climate-related financial metrics that would need to be added to audited financial statements, Scope 1, Scope 2, and in many cases, Scope 3 greenhouse gas emissions disclosure, and prescriptive requirements addressing what a registrant needs to disclose in 4 additional areas. In particular, how climate-related risks affect its strategy, business model, and outlook, targets and goals, risk management, and governance. On the next 2 slides, we'll give a very brief overview of the proposed rule, highlighting some of the more interesting and controversial points. So next slide. So we won't go through all of the points here, which themselves are only a sort of short and incomplete summary of everything that's in the SEC's rule. We will focus first on the 2 most controversial aspects of the proposal, which are the proposal to add a note disclosing climate-related financial metrics to audited financial statements and disclosure regarding greenhouse gas emissions. So taking those in turn, Under the SEC's proposal with respect to audited financials, registrants would be required to calculate the impact of severe weather events and other natural conditions conditions, as well as transition activities on each individual line item in the financial statements. If the absolute value of an impact on any line item exceeds 1% of that line item, registrants would need to include disclosure. The proposal raises a number of difficult questions, including how and if registrants would measure impacts like lost revenue that wouldn't normally be accounted for under accounting rules, but would seem to be required under the SEC's proposal. The 1% threshold has also been highly controversial. It is far below the materiality threshold typically used by registrants when considering disclosure, and commentators have noted that the few examples of a 1% threshold cited by the SEC, such as related party transactions and excise taxes, are very different in nature and scope than what is included in the proposed rule. Importantly, the proposal would have the new requirements for audited financial statements come into effect fairly quickly. If final rules are adopted by December 31 of this year, the proposal would have the new requirements for audited financial statements and most of the other requirements in the proposal become effective for fiscal year 2023 for large accelerated filers, meaning information would need to be included in annual reports beginning in 2024. Compliance date for accelerated and non-accelerated filers would be a year later, and the compliance date for small reporting companies would be a year after that. As a result, once the final rules take shape, people may need to move quite quickly to implement appropriate controls and procedures to meet these requirements. The next aspect of the rules that we'll talk about are the disclosure requirements for greenhouse gas emissions. The proposal would require all issuers to disclose Scope 1 and Scope 2 greenhouse gas emissions. Scope 1 emissions are emissions from sources controlled by the organization, and Scope 2 emissions are indirect greenhouse gas emissions associated with purchased or acquired electricity, steam, heat, or cooling. Accelerated and large accelerated filers would be required to obtain third-party attestation over those disclosures, beginning in fiscal year 2024 for large accelerated filers and the following year for accelerated filers. Initially, that attestation could take the form of limited assurance, which is a form of negative comfort, meaning the person making the attestation states that after performing certain procedures, that person is not aware of any material issue. After 2 years, however, reasonable assurance would be required. That is a much higher standard. By comparison, audit opinions are typically at a reasonable assurance level. So registrants other than smaller reporting companies would also be required to provide Scope 3 greenhouse gas emissions if material to the registrant. Scope 3 emissions are all indirect greenhouse gas emissions not otherwise included in Scope 2 emissions, which occur in the upstream and downstream activities of a registrant's value chain. So this goes back to the point Michael was mentioning earlier. This is really one of the places where the SEC's proposal has the potential to have meaningful impacts on private companies. Because in order to calculate Scope 3 emissions, an SEC registrant is going to need to know the emissions of other parties in its value chain, basically people it's doing business with, either that it's buying things from or that it's selling things to. While some of that can be calculated based on estimates and sort of industry averages and values, it's likely that registrants would, if this comes into effect, start asking private companies to provide emissions data to help the registrants calculate their own Scope 3 emissions. So this has been a particularly controversial aspect of the proposal, with some arguing that it goes too far in requiring disclosure, and some arguing that it does not go far enough. There's also been significant discussion and controversy over what material means with respect to Scope 3 disclosures, in light of some statements the SEC made in the proposing release, which could be read to indicate that the materiality determination here would be a little bit different from and would result in more things being material than how one would typically think about it under the traditional standards used by the SEC in courts. So those are the two most controversial pieces of the proposal, and we'll quickly highlight a few other areas as well. So the SEC's proposed requiring registrants to identify climate-related risks to their strategy, business model, and outlook over the short, medium, and long term, and to classify those risks as physical or transition risks. Proposed rule would provide prescriptive requirements as to what needs to be disclosed for those risks, including, for example, location data down to the zip code level for physical risks. Rule would also require disclosure of analytical tools such as scenario analysis that are used by registrants. A number of commentators have expressed concern that may induce registrants not to use those tools, in particular in light of the fulsome disclosure requirements regarding those tools that would be required. For example, people would need to disclose inputs, outputs, and parameters of scenario analysis, which in many cases would require information that could be forward-looking, that companies wouldn't otherwise disclose, and that they may think of as proprietary and competitively sensitive. Similar concerns have been raised about disincentives and unintended consequences related to the proposal's requirements for targets and goals and transition plans. Proposal would require detailed, can we move to the next slide? I'm sorry. So the proposal would require detailed disclosure of targets and goals adopted by the registrant, including interim goals, as well as detailed disclosure regarding transition plans. Importantly, the proposal does not mandate the use of any particular analytical tools or the adoptions of targets, goals, or transition plans. Rather, it would require specific disclosures be made if those tools are used by a registrant. Finally, the last piece of the SEC's proposal that we'll discuss today relates to corporate governance and how that intersects with climate-related risk. The SEC's proposal would require detailed disclosure about how a registrant's management and board of directors manage and provide oversight with respect to climate-related risks. Most notably, the SEC's proposal would require registrants to disclose if any director has expertise in climate-related risks, which many have expressed concern will influence registrants to feel they need to try to find someone with that expertise to put on the board. So again, that's not a requirement of the rule. The requirement is just to disclose if you have someone with that expertise on the board. The SEC has also included a similar requirement with respect to cybersecurity risks in its proposal on cybersecurity disclosures, requiring registrants to disclose if they have anyone on the board with cybersecurity expertise. And a number of market participants have expressed concern that it's inappropriate for the SEC or will be counterproductive for the SEC to induce companies to create particular slots on their board for directors with particular expertise as opposed to generalists. Now, can we move to the next slide? Right, so before we move away from climate to talk about human rights due diligence, we want to flag one final important point. And that point is that the SEC is not the only game in town when it comes to climate-related disclosure requirements. Notably, the California Senate passed earlier this year, and the California Assembly is currently considering, and a few committees in the Assembly recently approved, a bill that, if adopted, would require many US-based businesses to provide greenhouse gas emissions disclosure. That bill is in many ways broader than the SEC's proposal on greenhouse gas emissions. Among other things, it would require Scope 3 disclosure from all companies subject to it without a materiality qualifier, meaning it would apply to both private and public companies that do business in California and have revenue in excess of the threshold. Other states may consider additional legislation addressing climate-related risks, and non-US jurisdictions are considering and have begun to adopt and impose their own requirements. All of which is to say it will be very important to keep an eye on this space and to keep current, as obligations may come fast and furious from a number of different places and have both direct and indirect effects on both public companies and also on private companies. So now I'll turn it over to Sam to talk about human rights due diligence.
All right, and if we can go to the next slide. So in this next section, we're going to talk about 4 of the key pieces of legislation and laws, regulation that are out there currently. I'm not going to delve into specifics about these laws and try and provide a bit of a compare-contrast between them. You'll also notice that a lot of them follow very similar paths. For example, all 4 require due diligence, but what that exactly means differs between the 4. As well as just noting that due diligence, that isn't the typical legal term that we think of. That is an umbrella term that means a lot of different activities that the company is going to have to partake in to make sure that its supply chain that they are finding the risks that are there and that they are managing them effectively. All right, so can we go to the next slide? First up is the German Due Diligence in the Supply Chain Act. Of the acts that we're seeing, this is currently the most prescriptive law. If you were to actually look at the law, you would see that there's almost a checklist of things that companies that are subject to it are going to have to do to be in compliance. So subject companies, the act's going to apply to companies that have a head office, principal place of business, administrative headquarters, registered office, or branch office in Germany. Then in Germany, as of at least 2023, it's going to apply to companies with 3,000 or more employees. That threshold is going to lower to 1,000 or more employees in 2024. Then compliance, of course, begins January 1st, 2023. So it's taking a step back. The German Act applies to a broad range of human rights and environmental risks. So we're talking, this includes modern slavery, this includes decent working conditions, as well as the environmental risks. There's a lot of mercury they're incorporating a lot of existing human rights under international accepted terms. In regards to due diligence obligations under the law, again, I'm not going to get into all the specific details that it requires, but an overarching way of looking at it, it requires risk management systems. So that includes preventative and remedial measures. Risk analysis is going to have to be done. There needs to be a complaints procedure. Then there's going to need to be a policy statement that is actually kind of formalizing everything that's required by the Act. Then there's also a documentation and record keeping requirement, and I believe that's for 7 years to keep track of all this due diligence process that you've been completing. Then of course, under the Act, there is also an annual reporting requirement. Just as a fun fact, that report will need to be in German, so keep that in mind. And that report's going to have to cover the human rights and environmental risks identified, the measures taken to fulfill the duties of care, how the company assesses the impact and effectiveness of the measures taken, and the conclusions drawn from the assessment for future measures. And then of course, if you do not comply with the Act, the penalties can be pretty steep. Fines can be up to 2% of the average annual sales. Before we go on to the next slide, I just wanted to note that one thing to keep in mind about the German Act is that all the requirements under the Act apply to the subject German entity. So for example, if you're a global company and you have global policies and procedures, that's fine. But in order to comply with the German Act, you just need to note that the German entity is complying with those global procedures and policies. All right, can I go to the next slide? So under the German Act, it is subject companies are responsible for managing and addressing human rights, environmental risks, and that extends to the entire supply chain. So the company specifically, you're going to have to be looking at the company's operations as well as its immediate suppliers or direct suppliers. In regards to indirect suppliers, the due diligence obligations will only apply if the company has substantiated knowledge of a possible human rights or environmental violation. Also, the duty of care is going to be a little bit dependent upon a few factors, such as the subject company's business activities, its ability to influence the direct cause of the risk or violation, the typically expected severity of the injury, the ability to remedy the injury, and the likelihood of occurrence. Then lastly, the subject company's relationship to the risk or violation. So next, we're going to jump over to Norway. Can we go to the next slide? Perfect. So in Norway, they have the Norwegian Transparency Act, and this actually just went into effect earlier this month. It is covering 2 different areas, both enterprises domiciled in Norway, as well as large foreign enterprises that offer goods and services in Norway that are taxable in Norway. So this is where we're going to capture a lot of those US-based companies that have international operations. Subject entities also have to meet 2 following thresholds: sales of 70 million Norwegian krone or balance sheet of 35 million Norwegian krone, and then average number of 50 employees during the fiscal year of 50. One thing I should note, that 70 million and 35 million krone are actually very low thresholds, and so a lot of companies might find themselves surprisingly subject to this law. For conversion purposes, 70 million krone is about $6.7 million US, and 35 million krona is 3.4 million US dollars. So if you're finding yourself subject to this act, what it's going to cover is fundamental human rights and decent working conditions. Unlike the German act that actually is very prescriptive on what you have to do, this law is actually incorporating the OECD guidelines for multinational enterprises, and those are overarching guidelines of what that due diligence process should look like. And on the next slide, I'll walk you through it at a high level. But before that, the law also has a annual reporting requirement similar to the German law. And in that report, the companies are going to have to give a general description of the business, its area of operation, guidelines, procedures for addressing actual and potential adverse impacts. Then we're talking about adverse impacts and significant risks of adverse impacts uncovered through due diligence. And then the measures the enterprise has implemented or plans to take to cease or limit adverse impacts and the results of those measures. One last thing I'll note about this before we go to the next slide is that there is a fun element where third parties can request information from the company on how it addresses identified or actual potential adverse impacts. All right, next slide. So you'll see in blue here this is kind of short list of all the human rights that are addressed by the Act. So for each of these rights, you kind of have to think about it. You need to assess whether or not this right is applicable to your business, or if the adverse impact caused or contributed by the company is significant. And then if you find that it is or it is applicable to the business, whether it is actively managed or addressed by policies and procedures of the company. Then as previewed, those OECD due diligence guidelines, similar to the German Act, you'll see they sound somewhat similar. You're going to need to embed responsible business conduct into policies and management systems, identify and assess adverse impacts in operations, supply chains, and business relationships, cease, prevent, mitigate adverse impacts, track implementation results, communicate how impacts are addressed, and provide for or cooperate in remediation when appropriate. So if you think about it, if you are already in compliance with the German Act and abiding by those requirements, you're very likely already well on track to being in compliance under the Norwegian Act. So going to our last state-specific law, over to Switzerland, the Swiss conflict minerals and child labor due diligence legislation. So unlike the other two that had a wide range of human rights, this law is focusing specifically on conflict minerals and child labor. And you can think of them as two pillars of this law, and you need to check the box for both. Under this law, the entire supply chain is covered. And subject enterprises, it can be any registered office, central administration, or principal place of business in Switzerland. So that seems pretty broad, but as I'll cover in a moment, there are a number of exceptions so that you don't need to comply with the due diligence and reporting requirements under the law. Let's just assume for purposes of this slide that you did not meet any of those exceptions. So the law would require subject enterprises to conduct due diligence in respect of both conflict minerals and child labor risks, assuming you didn't have an exception for either of those pillars. And that would mean putting in place adequate management systems again, that would include a supply chain policy and a system for tracking the supply chain. Also be required to determine and evaluate the risk and adverse impacts in the supply chain, prepare a risk management plan, and take appropriate measures to mitigate. Again, there would be an annual reporting requirement, and then non-compliance with the law could result in violations up to 100,000 Swiss francs. Going to the next slide. So these are the exceptions that I mentioned. I'm not going to go too much into conflict minerals, only because I think a lot of companies actually probably aren't likely to be, they're likely to be excluded from this, as well as maybe a lot of the companies on this call. And that's because the Swiss law is following the EU interpretation of conflict minerals regulation, where they're really looking at higher up the chain. So they're actually asking, is that core 3TG material being imported? For example, like a sheet of tin, as opposed to like the US conflict minerals that says, do you use 3TG anywhere in your products? And therefore it can go far up the supply chain. So again, I'm not going to touch on conflict minerals too much and focus a bit more on the exceptions of child labor, because a lot more companies are going to find themselves subject to this. So again, these are the exceptions to the due diligence and recording exceptions. So you can find yourself excused from those obligations if you are a smaller medium enterprise, and you would meet that requirement if you are under two of the following thresholds. That's 20 million Swiss francs, sales of 40 million Swiss francs, and 250 full-time employees on average. I'll note that the Swiss franc kind of is tracking the euro right now. It's doing a little bit better. So that 20 million is pretty much equivalent to 20 million US dollars. Another exception is that if your business is at low risk of child labor, and they consider low risk, they map that according to the UNICEF's Children's Right in the Workplace Index. So any country designated as basic. And then lastly, a lack of reasonable suspicion. So the counter definition here is that there is a reasonable suspicion of child labor if there is a specific information available that would lead a reasonable person to believe that a product or service involves child labor. Then last exception, this is, again, there's one for child labor pillar, one for the conflict minerals pillar, but if you have equivalent compliance with an existing international framework. So for example, if you are if your due diligence system is already in compliance with the ILO minimum age convention, worst forms of child labor convention, and the ILO IOE child labor guidance tool for business, as well as the OECD due diligence guidance for responsible business conduct, then you don't need to follow this law's due diligence requirements, because you already have a system in place that they are saying is good, it works for them. So you're just going to need to have proof that you are complying by that. So next slide. So the last thing that I'm going to cover is the EU Corporate Sustainability Due Diligence Directive. Note this is different than the Corporate Sustainability Reporting Directive, which could replace the non-financial reporting directive. So that focuses mostly on reporting. This is primarily focused on due diligence, but there, of course, I should note, there is a reporting requirement underneath this CSDD directive. But if you were reporting under the NFRD or potentially the CSRD, then you don't have reporting obligations under this directive. So the scope, again, we're back to a wide array of human rights and environmental impacts, and that's at operations, at subsidiaries, and it's also at direct or indirect business relationships in the value chain. So this can go up or downstream. There are, again, due diligence requirements. This follows similar requirements as all the other acts that we've covered. Subject companies, you can think of it as a bit of a chart. There are EU companies on one side, non-EU companies that are also going to be applicable. And then both of those columns are going to be broken into size thresholds, with large companies being considered group 1 and smaller companies being considered group 2. So here you'll see that under EU companies, 500 employees average and 150 million euros worldwide turnover, that would be considered the EU group 1, as well as non-EU companies that have 150 million of EU turnover, or that would be considered the non-EU companies group 1. So again, this law, it has a lot of requirements. We're going to cover a bit more on the other page, but just noting that it's still in the proposal phase, and it's going to need to go through the tripartite agreement of the 3 branches of the EU. And this is the Commission's proposal. So it's very likely that we might see, for example, the Parliament might want it broader, and the Council will likely try to slim it down. So this is not finalized, but we just wanted to give you a sense of what it's looking like. Again, once the EU agrees upon the law, then member states are going to have 2 years to actually transpose the directive into their national laws. So then compliance, that means, would be beginning no earlier than 2024. Next slide. So these are some of the elements and defined definitions. Not going to focus on this too much, but again, just noting that the law deals with both established business relationships and the entire value chain. Next slide. Again, there is a reporting requirement. There are also directors' duties that applies only to EU companies or the entity in the EU. There's also climate change requirements that is only going to be applicable to Group 1 companies, so those larger companies. And then, of course, as Michael noted, a lot of these laws, they all have enforcement, penalties, repercussions. And so there is going to be enforcement liability given to the member states to actually figure out how they want to have this be enforced. So with all of that information, now we're going to give you more, and I'm going to pass it over to Michael for trade-based regulation.
Sam and Mark for those great overviews. Obviously a lot here for companies to unpack, and we're going to throw even more at you. The three areas that I'm going to cover, I'll talk a little bit about just some of what we're seeing on trade-based regulation in this area. Then we'll talk a little bit about deforestation, a little bit about modern slavery, and then I'll close with a couple of compliance tips. And if we have some time, we'll answer some questions, but we are going to try to keep the trains running on time and let everybody off at the top of the hour, just because we do want to be sensitive to other things that people have going on. So let me start with trade-based regulation. And so, when we're talking about trade-based regulation here, really what we're talking about is prohibitions on importing products that are used, that are produced using forced labor. Now, legislation in this area is not new. It's existed in the United States since 1930, although for reasons we won't get into today, until 2016, that legislation was largely dormant, so Section 307 of the Tariff Act. And since that time, really, we've seen a substantial uptick, accelerating over time in enforcement of 307. But not only have we seen this uptick in enforcement, we've also seen additional legislation that's been proposed and adopted that's leveraged off of 307 of the Tariff Act. Let's go to our next slide. And in particular, the one that I want to talk about today is the Uyghur Forced Labor Prevention Act. This particular act was adopted in the United States toward the end of 2021, so in December 2021, and in a rare occurrence these days in the United States, this one had extremely strong bipartisan support. It was passed almost unanimously in both the House and the Senate. And there's three key aspects to the Uyghur Forced Labor Prevention Act. So first, it sets up a presumption that any labor that's linked to the Xinjiang region of China is forced labor for purposes of 307 of the Tariff Act. It also requires the U.S. government to develop a strategy to address Xinjiang forced labor, and then it also provides enhanced authority of the U.S. government to impose sanctions. And the piece of this that we're going to focus on today is the forced labor presumption, and that forced labor presumption just recently took effect. So it took effect late last month. So we're still in the very kind of early stages of kind of seeing how enforcement of the forced labor presumption plays out. But it is going to have a significant impact on a lot of companies in their supply chains. So there's particularly affected supply chains such as the apparel supply chain, the agricultural supply chain, and the solar supply chain. But the U.S. government estimates that there's maybe 20 or so different industries that have inputs that include Xinjiang labor. And so, it's much broader than just those particular industries. Let's go to our next slide, please. And so I'm going to just get into in a little bit more detail the forced labor presumption and the way that works. The Uyghur Forced Labor Prevention Act, so as I mentioned, it creates a presumption that for purposes of Section 307 of the Tariff Act, labor that's linked to the Xinjiang region is forced labor. And so a couple of things on that presumption. So first, it's a rebuttable presumption. So you can disprove that presumption, although there's a high standard of evidence for doing so, as we'll talk about. And the presumption applies to not only goods that are produced wholly or in part in the Xinjiang region, and by wholly or in part, it's really any inputs that come from that region. The goods don't actually have to be, fully produced or shipped out of that region. And then also it applies to goods that are produced outside of the region, but that are using labor from Xinjiang, so Uyghur labor in particular, that's through government-sponsored pairing or other government-sponsored labor programs. Now, as I did mention, you can rebut the presumption, and there's kind of a couple of exceptions to the presumption. So first, if the importer is able to comply fully with guidance and implementing regulations that come out under the Act, and they otherwise have responded to all of the inquiries that they've received from Customs and Border Protection, or if by clear and convincing evidence, the Commissioner of Customs and Border Protection determines goods were not produced wholly or in part using forced labor. And so when you kind of boil all of this down, I mean, really what you're kind of trying to do as an importer is you're trying to either show that there's no Xinjiang inputs in the particular product, or you're trying to show that if there are Xinjiang inputs that they don't involve any forced labor. And that second inquiry, just based on availability of data, will probably be the harder of the two for a lot of companies to be able to demonstrate. So let's go to our next slide. So there has been some guidance that's come out for importers, and there's really kind of two things that have come out. So first, there's a forced labor strategy that was delivered to Congress, and that was delivered by the Forced Labor Enforcement Task Force, which Homeland Security leads. And then there was also additional guidance that was put out by Customs and Border Protection. Both of these came out in mid to late June, and they don't provide bright line guidance in every respect on how to navigate the Act, but they do provide some additional guidance to importers, which was largely consistent with prior U.S. government guidance. A couple of things just to note on the guidance that's come out is companies do need to conduct due diligence, and there's an expectation outlined in the guidance that companies actually conduct heightened due diligence, so maybe more than you're doing with respect to goods that are coming from other parts of the world. And here, that concept of due diligence is a broad concept of due diligence. So, like what Sam was talking about in the context of mandatory human rights due diligence legislation in Europe. So it's that same concept of everything from kind of policies and procedures through risk assessment, through risk mitigation, monitoring compliance, so on and so forth. Also, the guidance indicates that importers are going to have to engage in effective supply chain tracing. So to the extent that Customs and Border Protection denies entry of goods, you're really going to be able to have to show kind of full chain of custody throughout the the entire life cycle of the goods. And then you're also going to have to be able to demonstrate that you have supply chain measures in place to prevent and mitigate identified risks of forced labor. Now, I've focused, on the Uyghur Forced Labor Prevention Act, but, this is not this and 307 it's not the only legislation kind of addressing this issue. So, Canada also has equivalent legislation that's in place that they adopted in 2020 as part of the US-Canada-Mexico agreement, so the successor to NAFTA. Also in Australia, there's a proposed legislation as well that would impose a ban on imports that are produced using forced labor, and the EU has indicated that it intends to propose legislation at the EU-wide level. So let's go to our next slide. So the next topic that I want to briefly hit on is deforestation legislation, and this is an area that's rapidly developing, and this is one that's a couple of years behind what we're seeing on climate risk disclosure, but I think it's going to catch up, and it's one that you're going to be hearing a lot more about. And deforestation is linked to climate change because it's a significant contributor to greenhouse gas emissions and global warming, but there's also another element to deforestation. So there's the environmental and human rights aspects of it that are separate from climate change. And I'm going to highlight three specific pieces of legislation here. So let's go to our next slide. The first instrument that I want to highlight is the UK Environment Act, and this is a much broader piece of legislation, but does include a chapter in it on deforestation that's specific to that issue. So the Environment Act was adopted in late 2021, and the piece of this that deals with deforestation, it would prohibit persons that are regulated under the Act from using forest risk commodities or a derived product in their UK commercial activities unless that person complies with relevant local laws relating to land ownership and use. And this act would require companies to identify deforestation risks. It would require them to assess risks of non-compliance with local laws, and then also take steps to mitigate that risk. And then there would be a reporting element to the act as well. A lot of the details on this one are left to secondary regulation, which the UK government is in the process of putting together. So the UK government just recently ran a consultation, on the secondary regulations, asking for input on a number of different areas. That consultation just closed in the last month or so. So we will be seeing secondary regulations coming out on this one, but we're not quite there yet. So a lot of the details on who's exactly going to be subject to this, which commodities will apply, when they'll apply, and what companies will have to do, is still to come out. So so stay tuned on this one. Let's go to the next slide. The next one I just want to note is the EU also has introduced EU-wide deforestation legislation in the form of a regulation, and this one would not only prohibit products that are non-compliant from being introduced into the EU market, but would also prohibit the exportation of products. And this one also would require due diligence, although the level of diligence would depend upon the level of risk of the particular country of origin, and then also would require due diligence, reporting on due diligence as well. So this one's at the proposal stage. The Commission proposed a regulation on during November of 2021, and so we'll kind of have to see how this one progresses. The Commission has indicated that they would like to see something adopted relatively quickly. I think we probably won't see anything adopted on this one until probably sometime in 2023. Next slide. And then the last one that I want to hit on deforestation is a bill in the United States. And so this one would amend the Tariff Act, and so it would be an import-driven regulation. So it would restrict companies or importers from importing into the United States products that are made wholly or in part of a covered commodity that's produced from land that's undergoing illegal deforestation. So this particular bill was introduced in both the U.S. House and Senate during October of 2021. There hasn't been a lot of progress on it. I think it's probably unlikely that this one winds up getting adopted, but certainly, at least not in its present form, but it's certainly something that I think also should be on companies' radar screens. Let's go to our next slide. So the last substantive area that I want to briefly hit on is modern slavery legislation. And in particular, what I want to talk about are some amendments that are going to be coming on the UK Modern Slavery Act. Let's go to our next slide. And just to level set for those of you who may not be that familiar with the UK Modern Slavery Act, so that act was adopted in 2015, and at a very high level what it requires is subject commercial organizations to prepare a slavery and human trafficking statement. And in that statement, companies have to indicate the steps that they took during the prior year to ensure human trafficking isn't occurring in their supply chain or in their business. And the Act is principles-based in nature. There's recommended disclosure topics, so not mandatory topics. There's also no fixed due date for publication of the statement, and then also there's no monetary penalties under this one for non-compliance. Let's go to the next slide. So a big complaint, of civil society around the UK Modern Slavery Act is that it's of limited effectiveness because, it's high level in terms of what companies have to disclose by being principles based, and then there also aren't any real teeth in the act for non-compliance. So there's a number of amendments to the act that the UK government intends to implement. So first, they're going to move topics from being voluntary to mandatory. Also, statements will be required to be published on a government-run registry. That registry is already up and running, but right now, publication on that registry is voluntary. Also, there is going to be a fixed reporting deadline for statements, and all companies will be moved to the same deadline as opposed to the voluntary fiscal year construct that currently exists in the statute. And then also, the government intends to introduce more robust enforcement mechanisms, although what those are going to look like still remains to be seen. So there isn't a particular timetable for the amendments to the act to be introduced, and most of these changes, they will require Parliament's approval. So it's not something the government can just do on its own initiative, and the government has indicated that that the changes will be effected, when time allows within Parliament. Let's go to our next slide. So where I want to end here in our formal remarks is just to talk a little bit about practical guidance, and we'll go to the next slide. So I want to leave people with some practical compliance tips to think about the topics that we've talked about today. So just to kind of try and tie all of this together. So, is a threshold matter, this goes back to kind of full circle where we started. You're going to want to be thinking about, first assessing applicability, the various pieces of legislation that we've been talking about. So, as a initial matter, do you hit the statutory compliance thresholds of the different instruments? But if not, are there also other compliance drivers? So, for example, commercial drivers that would, require you to be kind of thinking about compliance, and maybe not full compliance, but like compliance with some of these. The other thing that I think is really important to keep in mind when you're thinking about a lot of the legislation that we've talked about today is that, you really do need to take a thoughtful, measured approach. It's not as simple as just, adopting a policy or, kind of going through a checklist of a couple of compliance items, because most of these, do take a risk-based approach to compliance. You need to start by assessing risk and thinking about what the risks are in the particular subject areas relating to, the individual instruments. And then based on that level of risk, you'll think about, well, what are the compliance procedures that you need to take to address, the particular risks in your business. And as part of that, you want to look at, the adequacy of your existing compliance policies and procedures, because often what we find is, companies have a good, base in place already. And so it's not so much usually about putting in place new procedures, but how you're going to modify and enhance, existing compliance procedures and programs. Then, the other thing you want to be thinking about is just harmonization, with what you're already doing, and harmonization across your organization. So a lot of the regulation that we talked about today does have a disclosure component. So you're going to want to think about how do those disclosure requirements tie to, other disclosures that you're already making in your business, because a lot of you are putting out a lot of voluntary corporate social responsibility disclosures. You're going to want to leverage off of existing compliance initiatives. So as like I mentioned, there's probably a lot that a lot of you are already doing that provides a good basis for compliance. So you're not going to be starting a compliance program around these areas from scratch, and then, you know, integrate into existing compliance initiatives. You know, I think where you can, you want to have a global holistic compliance framework for addressing risk and opportunity, rather than kind of looking at all of these, you know, kind of individual pieces of legislation in their own silos. And then finally, you know, I think you want to, you know, just be aware of the broader world of, you know, kind of how people are addressing compliance in these areas. So you're going to want to be benchmarking against your peers where that's relevant. There's a lot of NGO guidance out there on the topics that we've talked about today. You're going to at least want to be aware of that. You're going to want to be aware of other third-party compliance frameworks. So there's a lot of, you know, kind of voluntary compliance frameworks out there to help companies, you know, kind of think about compliance. And some of those are also being incorporated into law. So things like the UN guiding principles and the OECD M&E guidelines. And then also, you know, for those of you who are public, you're certainly going to want to be thinking about investor expectations around these issues, which are increasing, and then also thinking about ESG ratings as well, since that's another area that factors in here, because a lot of the disclosures that companies put out around these issues are taken into account in ESG ratings. So I think we're going to end there. I know we're at time, so I think, you know, rather than taking questions today, we did have a bunch of questions that came in. I think what we'll do is, you know, we'll collect those from ONDAC, and where appropriate, we'll certainly try to reach out and respond to people. I think, though, you know, you've all been a terrific audience based on all of the engagement that's come in, you know, through the chat room. And I again want to thank, you know, Sam and Mark for their big contribution to today's program, and also thank Mondac for giving us the chance to present this program.